Hi, I'm Andrew Berman from the Mortgage News Network, coming to you from the MNN studios here in New York. We have Tom Lamalfa, who's president of TSL Consulting, who's going to share with us the MBA 2017 report that he does every year. And I got to say, it's one of the most look forward to reports in the mortgage industry. It comes right after Groundhog's Day, and some might say it's a little bit like the Groundhog's Day report, but a lot more accurate. Tom, thank you for joining us.
Thank you, Andrew. I appreciate the introduction, and I appreciate the opportunity to appear today. I'm a mortgage market analyst and a researcher who has been in this business for many years. This year is 40 years, to be quite exact.
Wow.
Every 6 months for a decade now, I've conducted a survey of senior mortgage executives. I conduct these surveys twice a year at the MBA's annual convention and at the MBA's National Secondary Market Conference. At this latest MBA event, I met face-to-face with 28 executives representing 28 separate firms, a cross-section of mortgage lenders of all sizes and from all parts of the country. Survey participants ranged from a California-based mortgage broker who originated $85 million of production last year to several of the nation's largest mortgage lenders. You can read all the details in the November 2017 issue of the National Mortgage Professional. The article displays the questionnaire, explains the survey methodology, overviews the findings, discusses the structure of the panel, and reviews the history of the survey. This latest questionnaire included 69 questions covering production, products, regulations, the GSEs, the FHA, technology, and more. Fannie Mae was the sponsor of this year's survey. Here's what I learned. Industry leaders do not expect a sharp upward spike in interest rates in 2018. Further, they expect that last year's origination volume would be somewhat less than in 2016 and to slow further this year. Recall, originations totaled $2 trillion in 2016 and declined to $1.7 trillion last year. Volume is expected to total somewhere between 1.2 and 1.6 trillion this year. If it's at the latter end, it would be a drop of 40% year over year. As for 2017's product mix, here are the averages for the group of 28 firms. 60% of last year's business was in conventional loans, the GSE sector. Just fewer than 30% were government insured, FHA, VA, and rural combined. The purchase refinance split was 72% purchase business among the 28 firms and 28% refinance. Slightly more than 1/3 of their business consisted of loans over 80% LTV. Looking at costs, overall expenses are higher due to compliance costs and technology's demands. Meanwhile, profits were down year over year in 2017. As of last October, lenders were still hiring, but the fevered pitch of more recent years has greatly subsided. As for the GSEs, overall, lenders are quite pleased with Fannie Mae and Freddie Mac. Their products, programs, policies, and technology all received high grades. Lenders like their technology initiatives, especially Fannie Mae's one-day certainty and Freddie Mac's loan advisory suite. Lenders support the FHFA's decision to increase the DTI cap to 50% without requiring compensating factors. Lenders overall enjoy a strong level of customer service from the two GSEs. As I said, industry executives give them high marks. Lenders told me that, and again, I'm using an average for the group of 28, lenders told me that compliance is costly as it now consumes 1/5 of total operating expenses.
Wow.
Compliance post Dodd-Frank appears to have added about $1,800 to the cost of originating a mortgage. The best news on the cost side is that expenses are beginning, and I emphasize the word beginning, to stabilize after years of back-to-back increases. Lenders differ as to whether all the new post-Dodd-Frank rules have made mortgage finance safer for consumers. Certainly, it hasn't harmed them other than their pocketbooks. However, from a cost-benefit analysis perspective, lenders are nearly unanimous in thinking consumers got the short end of the transaction, simply meaning costs outweigh benefits. Lenders do not expect GSE reform in 2018, but they do expect higher house prices prospectively. They think that refinances will dip to 25% of 2018's originations versus about 50% in each year over the past 7 years. Lenders also think that wholesale production and online originations will grow in popularity in the next several years. Time will tell. Lenders almost uniformly believe technology is fundamentally changing the way business is being done. They also say that it's much easier to get a mortgage today than at any time since before 2008. The executives say they are quite bullish about the credit characteristics of recent borrowers. They view their credit profiles as substantial and strong. Lenders foresee further expansion in the low down payment market. They aren't especially concerned about a crisis or a crash in residential real estate values, and they don't see a shift from the current seller's market to a buyer's market for another 3 to 4 years. That suggests continued upward pressure on home prices. The industry appeared quite well prepared and ready for the HMDA reporting changes that began on January 1st. Lenders are somewhat skeptical still about whether the recent loan officer compensation rules, now 2 years old, are always being followed across the industry. Finally, I learned that executives are planning for significant investments in technology this year, that margin compression due to keen competition is a universal concern again this year, and that credit standards continue to ease and thus default risk continues to quietly grow. In summary, origination activity will slow this year due to fewer refinance opportunities, tight inventories of homes for sale, and high home prices. Industry profits and employment will decline with reduced revenue. Expenses are gradually coming under control. Single-family real estate will likely account for a smaller slice of aggregate economic activity this year. Mortgage rates will likely remain friendly, but affordability continues to be a major issue, especially for millennials and first-time buyers in high-cost coastal markets. So in sum, the survey suggests a decent but unremarkable year in mortgage finance, one that is characterized by thinner volume, strong competition, more technology, and quietly growing risks. Thank you for the opportunity.
So, Tom, I just want to ask you, I got to 2 questions. So you mentioned that there's a 60%, for, as far as loan production, 60% conventional, 30% govies. That extra 10%, does that include, I'm assuming, the non-QM portfolio products?
Right, it's portfolio product. It's predominantly jumbo loans that are held in private hands by portfolio lenders.
So did lenders at all talk about actually, any kind of growing interest in the non-QM space?
No, very little, surprisingly. One would have expected more emphasis in that area, but I'm not seeing it. certainly not among MBA members. There's more of it going on outside of the MBA membership and among lenders who are not members. But I'm not really clued into that, and I don't think it accounts for more than possibly 3 or 4% total.
Yeah, makes sense. Now, cost of compliance is just astronomical when you think about this. Now, so it's $1,800 per loan today. Any idea what the number was pre-Dodd-Frank?
Yes, but let me back up just for a second. When I use that $1,800 figure, that is the amount in addition to X that has been added as a result, a direct result of compliance-related issues.
Oh, wow.
The prior to the number ranged, depending upon the production channel, anywhere from $3,000 to use some round figures to $4,000. So we're now talking about $4,800 to $5,800 to originate a mortgage loan. And that's pretty consistent with what we see through the MBA's performance measures.
Wonderful. Tom, thank you so much for sharing with us, and thank you for your time.
My pleasure. Good luck.
And I'm Andrew Berman from the Mortgage News Network. Thank you for watching.
This is Mortgage News Network.